You can be the most knowledgeable person at the trading desk, but if you don't know how to handle yourself when you press the buy and sell button, you're going to be an average trader at best. Unfortunately, few people know how to actually handle their emotions when trading. In today's video, we'll talk about the most common mistakes you are probably making on a daily basis, and I'll showcase the actual steps I took to become more disciplined and more patient. So, like, subscribe, and stick around for the full video. Here's an exercise which will massively improve your discipline. Open a demo account and blow it intentionally. Make all of your trading mistakes on that demo account because you first need to make them in order to learn not to repeat them. You basically get your trading mistakes out of your system. So open your demo account and go nuts. Make all the mistakes you know. Chasing a position, over trading having large positions, lose a trade and then open a second one to recover the losses, trade without stop losses. Blow your demo account, then open another one and repeat the same mistakes. Observe your mistakes, but also be aware of your feelings. Try to visualize that mistake on a live account and be grateful this is only a demo account. This exercise helped me to become more disciplined. It's weird, but it works. Learning how to trade correctly and eliminate mistakes is about doing something that's hard until it becomes easy. Making mistakes and failing means you are working through the hard parts. But a key point of this exercise is to remember your emotions, your state of mind, when you make a certain mistake. If you are doing it correctly, it will prevent you from repeating the same mistake on a live account. This sounds like a cliché, but you actually learn a ton from bad trades, specifically from reviewing them. I suggest you take a screenshot of the chart of a bad trade. Go back and look at it several days or weeks later. You'll look at it and say, what the hell was I thinking? Why did I enter here? In the end, screen time, practice, and education will make you capable of finding good trades, but learning to avoid the bad trades will make you profitable. Here's one of my own past struggles. I had an inclination to wait on a losing trade with the hope of getting out at break-even, but I used to take my profits very quickly because I got very anxious when I was in profit. It was very frustrating. Do you see the paradox? I was being too risk-averse when it came to profit-taking. I wasn't able to contain my emotions when in profit, but I was risk-seeking when it came to loss-taking. I have invested an excessive amount of time and energy watching losing positions than watching winning trades. You know the famous saying that 90% of traders are losers. But here's the reality. Most losing traders are not really consistent losers. They are instead blowing up their accounts on one bad trade. They don't slowly lose the funds in their account, trade by trade. In fact, they are making profits or preserve their capital at first. What ends their trading accounts is one bad trade, one stubborn trade, where they don't accept a small loss. You might be amazed, but most traders are blowing up their accounts on just a few bad trades, and this can be avoided 100%. It's easy to be overwhelmed if you load yourself up. Too many markets to keep track of, too many strategies to backtest. You need to narrow it down. I remember when I first started trading Forex, I used to have a template with over 20 currencies, and I woke up every morning and manually placed the support and resistance levels on each pair before the London Open, and I tried to monitor them simultaneously. And you know the outcome. Many missed trades, which resulted in many poor trades taken out of frustration. You have a lot of things to cover: market selection and preparation, pattern recognition, risk to reward, indicators, volume, position size, entry level, price action, trade management. It's easy to become overwhelmed. So when day trading, focus on fewer things at one time. Even though the price will go up or down, you don't need to trade every moment. There is enough money to be made trading only a few times each day. You don't need to sit in front of the screen all day. I spend an hour, maximum 2 every day, researching and trading, or maybe even less. But you must decide what works for you. You only need a few good trades a week to be profitable. I know that there's a tendency to try to squeeze every dollar out of the trading day, but when you have reached your profit target or you stop seeing setups, stop trading. When you realize this, you won't have the need to get into a trade, any trade, not to miss out on the profit. This reduces risk, losses, and trading commissions. After several similar mistakes, I now have a simple rule when I'm day trading. I must close my positions at the end of the day, even at a loss. You should never turn a day trade into a swing trade and hold it overnight. You know the feeling. You open a trade hoping for a quick profit, and instead of closing it, you find yourself justifying staying in a bad trade the second day. This is one of the deadliest sins a day trader can make. You need to change your mindset. Think about it. You can always get back in, but it's hard to recover from a big loss. You may think, I don't want to take a $100 loss. Well, you definitely don't want to take a $300 loss. And if you end up taking a $500 loss, it would be really hard to recover from that. Again, never turn a day trade into a swing trade. Take the loss and come back when the timing is better. In my first years, I used to average down on losing trades. Imagine you buy 10 shares of a company at $100 in anticipation of selling them at around $110. Instead, the stock breaks the support level and drops to $80. You have lost the trade and you should have been stopped out. But instead of accepting the loss and moving on, you buy another 10 shares at $80. And now you have 20 shares at an average cost of $90. It's unlikely the price will hit your initial target of $110. But now you're hoping that price will rally back to $90. Because at $90, you can sell all of your 20 shares at break-even and save the previous losing trade. Even better, if the price goes to $95, you can even record some profits. It's very tempting to average down on a losing trade with the hope of getting out at break-even. But you shouldn't do it. Averaging down a losing trade is a recipe for wiping out your account. 90% of time, maybe you'll profit when you average down. But the 10% of time you are wrong, you will blow your account. I've done it, and I still remember the frustration and the anger. Every day you hope that price will turn around and will save your account. It's a waste of mental energy, and I don't want to feel those emotions ever again. Fear of missing out is perhaps the deadliest of all trading sins that you can make. This is wishful thinking, and it can be a very costly trading mistake to jump into a trade before a pattern has either formed or been confirmed. It can also be a very costly trading mistake to chase a pattern that is visible but is not offering a good risk to reward opportunity. Although FOMO is very dangerous, it's actually very easy to avoid it. You just need to ask yourself one simple question before entering any trade. What is my risk to reward ratio in this trade? If you cannot identify a good risk to reward, it is a fear of missing out trade, and you should not take it. If you cannot determine a stop loss or profit target, then it's a trade based on FOMO, and you shouldn't take it. When we talk about FOMO, we also talk about greed. If you see that the market is moving toward the weekly high with heavy volume, breaks the level, you might take a position, even though this wasn't your initial plan. And there is nothing wrong with that. It's not greed or FOMO, because you saw a clear signal of opportunity to take a position. But if you take a position because you saw a YouTube video saying that Bitcoin is going to the moon, or a Reddit post that said that it's time to buy a random stock and there's significant money to be made, then you are trading based on FOMO. You have to be able to make the difference between a FOMO trade and a trade which maybe wasn't in your initial plan, but it's backed by your technicals. Fear can be triggered, for example, by your concerns over your profitability and your account. If you are afraid to take a trade because you are too focused on the fact that your $5,000 account is now at $4,000 and you had 5 bad trading days in a row, this is not a mindset to have. Your previous losses have nothing to do with the trade you are about to enter. If you are concerned that the price action is not clean, or that the volume in the trade is not enough, or that you don't have a confirmation, that's okay. Those concerns are not based on fear. But if your concern over another loss is based on a bad trading day the week before, that is a disruptive fear. You have to realize that your current trade idea has absolutely nothing to do with how you have traded in the previous days. If instead of responding to the market, you are reacting to your own concerns regarding your profit, you are acting in fear, and this will take you out of the current reality of the market. Instead, you will be acting based upon your own uncertainties and insecurities. Whenever you fear pulling the trigger, try to find out why are you afraid. Is it because of the price action, or is it because of your own insecurities? Dealing with losses and failures on a daily basis can be difficult because no setup is perfect and every setup is unique. Even winning days are full of small mistakes and things that could be improved. In many other areas of life, perfection is a worthy goal, but not so with trading. I'm a perfectionist, and this is still one of my main struggles in trading. As a perfectionist, you're used to think inside a box rather than outside of it. As a trader, feeling uncomfortable is your new comfort zone. You must see what others don't. You test new ideas, new strategies, you seize new opportunities, and you take risks. This requires courage and the ability to keep going despite daily losses. It's very important to understand the risk and the probabilities involved in trading. Think of trading as a business that operates based on probabilities. The market is a random environment. Anything can happen at any moment. Having this understanding is the key to peaceful trading. A trader's career is based on probability and statistics. If you learn to trade proper risk-to-reward trades, you trade defensive, and you always use a stop loss, in the long term, you will make more money than you will lose. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. and check out our Academy program if you want to further level up your trading. Until next time.